Hey everyone, welcome back to our channel. Today, we've got an incredibly valuable topic to discuss, especially for those who are new to the world of investing. We're diving deep into the expert advice of none other than financial guru Dave Ramsey on how to start investing as a beginner. Investing can seem daunting, but with Dave's guidance, we're breaking it down into manageable steps to set you on the path to financial success. Segment 1. Understanding the basics of investing. Before we jump into the practical steps, let's start with the basics of investing. Dave Ramsey often emphasizes the importance of understanding what investing is and how it works. At its core, investing involves putting your money into assets with the expectation of earning a profit over time. These assets can include stocks, bonds, mutual funds, real estate, and more. Stocks represent ownership in a company, while bonds are debt securities that pay periodic interest. Mutual funds pool money from multiple investors to invest in a diversified portfolio. Real estate involves owning property with the potential for appreciation over time. It's crucial to have a basic understanding of these terms before diving into the world of investing. Segment 2. Establishing an emergency fund. Dave Ramsey's first piece of advice before diving into investing is to establish a solid emergency fund. Before allocating money to investments, make sure you have 3 to 6 months' worth of living expenses set aside. This serves as a financial safety net, protecting you from unforeseen circumstances and ensuring that you won't need to liquidate your investments in a hurry. An emergency fund provides financial security, allowing you to weather unexpected expenses without disrupting your long-term investment strategy. It's the foundation for a stable financial future and a crucial step in Dave's overall financial plan. Segment 3. Paying off high-interest debt. The next step in Dave Ramsey's investment strategy is to tackle high-interest debt. Before allocating significant funds to investments, focus on paying off high-interest debts such as credit cards and personal loans. High-interest debt can quickly erode any returns you might gain from investments. By paying off these debts first, you're essentially earning a guaranteed return by avoiding interest payments. This sets the stage for a stronger financial foundation before venturing into the world of investing. Segment 4. Start small with retirement accounts. Once you've established an emergency fund and paid off high-interest debt, it's time to start investing. Dave Ramsey often recommends beginning with retirement accounts, such as a 401(k) or an individual retirement account, IRA. Retirement accounts offer tax advantages and can be an excellent starting point for beginner investors. With a 401(k), your contributions are typically made pre-tax, reducing your taxable income. IRAs also offer tax advantages, with contributions being tax deductible in some cases. These accounts provide a tax-efficient way to grow your investments over time. Segment 5. Diversify your investments. One of the key principles Dave Ramsey emphasizes is the importance of diversification. Diversifying your investments means spreading your money across different asset classes to reduce risk. Different asset classes can include stocks, bonds, real estate, and even within stocks, various sectors and industries. Diversification helps protect your portfolio from the impact of a poor-performing asset class. While one investment might be down, others may be performing well, balancing out your overall returns. Segment 6. Understand risk tolerance. Dave Ramsey often stresses the significance of understanding your risk tolerance when it comes to investing. Risk tolerance refers to your ability to withstand fluctuations in the value of your investments without panicking and making impulsive decisions. Your risk tolerance is influenced by factors such as your financial goals, time horizon, and emotional temperament. It's crucial to have a realistic assessment of how much risk you can comfortably take on. Investments inherently come with risks, but understanding your own tolerance helps you create a well-balanced portfolio aligned with your financial objectives. Segment 7. Dollar cost averaging. Another strategy Dave Ramsey advocates for is dollar cost averaging. This involves consistently investing a fixed amount of money at regular intervals, regardless of market conditions. The beauty of dollar cost averaging is that it takes the guesswork out of trying to time the market. By consistently investing over time, you buy more shares when prices are low and fewer when prices are high. This strategy helps mitigate the impact of market volatility and can lead to a lower average cost per share over the long term. Segment 8. Educate yourself. Education is a cornerstone of successful investing, and Dave Ramsey encourages individuals to take the time to educate themselves about the investment vehicles they choose. Whether it's understanding the basics of stocks and bonds, learning about different investment strategies, or staying informed about market trends, continuous learning is essential. There are countless resources available, from books and online courses to financial news outlets. The more you know, the better equipped you'll be to make informed investment decisions. Segment 9. Stay disciplined and patient. One of the most challenging yet crucial aspects of investing is maintaining discipline and patience. Dave Ramsey often emphasizes the importance of staying the course and not succumbing to emotional reactions during market fluctuations. Markets go through ups and downs, and it's natural to feel uneasy during periods of volatility. However, successful investors resist the urge to make impulsive decisions based on short-term market movements. Staying disciplined and adhering to a well-thought-out investment plan is key to long-term success. Segment 10. Regularly review and rebalance your portfolio. Once you've set up your investment portfolio, it's essential to regularly review and rebalance it. Market conditions and your own financial situation may change over time, making it necessary to adjust your investment strategy. Regularly reviewing your portfolio allows you to ensure that it aligns with your current financial goals and risk tolerance. Rebalancing involves adjusting the allocation of your assets to maintain the desired level of diversification. This proactive approach helps you stay on track and make informed decisions based on your evolving financial landscape. If you found this video helpful, be sure to give it a thumbs up, subscribe to our channel for more insightful content, and hit the notification bell to stay updated. Remember, investing is a journey, not a sprint. Take the time to educate yourself, stay disciplined, and watch your financial future unfold. Thanks for tuning in, and we'll catch you in the next video. Happy investing!